if you are not using a trailing stop, you are 100% leaving money on the table. And nobody likes to do that. We're gonna go over 3 different styles, and after that, I'm gonna walk you through some live examples so you can see how this works in real time. Now, these 3 styles are progressively gonna get more complicated, but as they get more complicated, they're gonna get progressively better at maximizing your profits. So let's first start off with the ATR, or average true range. And so all this indicator does is it puts a line on your chart either below the price for when the market is going up or above the price for when it is going down. And so what it does is it tracks what the average pullback is in the market. If you got in a trade down here as a buy for going long, you're going to use the ATR to say, hey, I want to stay in the market as long as the pullbacks are consistent and normal in this market. So every one of these pullbacks, because they haven't broken below this blue line, are normal and a part of the current market trend. And until it breaks that, right here we can see it, the price breaks below that level, that's when we want to get out based on the ATR, because the pullback is greater than what the average has been previously in this current trend. And on my platform here, NinjaTrader, it actually prints you a little arrow that says, hey, the ATR is broken and you should get out. And that is a great trailing stop strategy, and it is very simple to execute. Now, of course, like everything in trading, it is not that simple and does not work that great every time. Where the ATR falls short is in a choppy, range-bound market. It works really well in those kind of easy, slow-moving trends. But when you're in a range-bound market like this, where the market's just whipsawing back and forth between support and resistance zones, it does a terrible job at maximizing your profits. For example, let's say we got in up here as a short because it's near these highs, and we looked to bet that the market was going to go down here. Well, because the ATR is struggling to keep track of what a normal pullback is, because the market's being inconsistent and whipsawy, well, the market sold off all the way down here, probably getting you a really, really good amount of profit on the trade at its peak, but you got knocked out all the way back here. And that's pretty much giving back 50% of your profits. And so that is where the ATR falls short. Now, what you can use instead that captures situations like this better is an exponential moving average trailing stop. And so all that is using an exponential moving average. And I have this set to a 21 exponential moving average. And the basic idea of this is when price breaks your exponential moving average, you get out of the trade. So if we got in short up here, betting the market's gonna go down, we stay in all the way until this bar right here breaks above that moving average. And so comparing that to our trailing stop, it does a lot better in capturing those profits. Now, if we jump back to the initial example where the ATR did so well, the exponential moving average definitely doesn't perform as well in these type of markets. You can see that right here, it got knocked out right here and here as well. But what you can do in these situations is you can modify your strategy briefly. An example of that is, I want to see the market have 2 bar closes below the moving average. So if it just has 1 candlestick break below and then immediately recovers it, that's totally okay. The market is, in my mind, of seeing that, it's holding the exponential moving average, and the moving average is keeping price up. Now, eventually, based on that, you do get knocked out at here, and that's totally okay. Of course, you're not gonna find an indicator that works perfectly in every market. The idea is finding something that works consistently enough to help maximize your profits. Now, to make things a little more complicated, let's look at this second example right here. Right here, when we get in, you can see that, hey, the exponential moving average is basically knocking you out right away if, let's say, we got in on this big bearish bar right here. And so what you can do, and I think what you should do, is use a trailing stop at a certain point in the trade. Let things get going first. Because quite often when you get in a trade, the market will chop around for a while. Because at least for me, I like trading reversals in the market. And when you're at a, let's say up here, a resistance level, the market's gonna bounce around a little while before it gets going. And so I don't wanna implement a trailing stop strategy too soon and get knocked out before the market takes off and you just miss out on a massive trade. You have to take risks in trading. And so I think the best way to do that is once the market gets going, that's when you put in your trailing stop. And so an easy way to do that is once the market hits 1 times your profit, or maybe 1.5 or 2 times your profit, that's when you put in your trailing stop, because you don't want to get knocked out of a trade too early. And so the last most versatile but hardest trailing stop strategy to use is using pure price action. This is 100% based on your ability to read the market in real time. Now, this is not easy to do. This takes a lot of experience in the market. But if you can do this, you can consistently adapt to the market and make your profits as high as they can be. And for me, this is my favorite way of doing it, because with a day like this, where the ATR does really well, you can do really well as well. If we got in up at this resistance level, betting the market is gonna go down, you would see that, hey, the market is making lower lows and lower highs. And that is a basic way to say the market's in a downtrend, and I'm betting that the market's gonna go in a downtrend, and so that's good for my trade. And then all of a sudden it starts puking lower. That looks great. And it pukes lower really quickly. And then it starts to chop around here a bit, but it doesn't really start making higher highs. And then all of a sudden we start to get a bounce here. And once you start seeing these higher lows here, you can get out. And so you could stop out right here. And so that captures the same amount the ATR does when it is at its best. And if we go to our choppy range example where the ATR doesn't do great, the EMA does good, well, reading the price action does good as well, because we would get out right down here when the market started to break this lower lows and lower highs move as it breaks above this previous high. And so that's all you're doing with price action trailing stops, is you're just reading the swings of the market. Where is the market making lower lows and lower highs? And then when that shifts to higher highs and higher lows. And that's where you get out with these trailing stops. Now, there definitely are other little nuances to it. Let's say you just got long right here, betting that the market's gonna go up off this support level. Another thing you can do is you can just use a trend line as your trailing stop. Based on these 2 touches right here, I would say you can confirm a trend line off of that. And then right as the market breaks this trend line with that big bear bar, jump out of the trade. And lo and behold, that's where it reversed. And that's another good way to trail your stop up. Now let's jump into a live example where I'm gonna show you how I use my trailing stops in real time. So first off, here we are in a trade betting that the market's gonna go down. And I initially have my stop above the highs. And for me, once the market gets going in my direction, like it makes some clear break of price action that is starting to sell off, this is a very clear example, I like to go to break even because I want to take that risk off the table. Now, generally, I like to go with the swings in the market. So as the market swings down and makes lower lows and lower highs, I like to move down with those moves. Now, one trick I've actually found is when the market sells off this strongly, you have to break away from that normal slow trailing stop, because going with the swings in the market works great. But when the market goes so far in your favor, you need to ratchet up your stop quickly, because as you can see right here in this example, the market snaps back really quickly. And down here, I was up about $1,000 and I've given more than half of that back. And theoretically, the market could go all the way up here and knock me out of break even. And I would have felt like an idiot giving all that money back up. I saw this red bar right here and said, okay, if it breaks above this red bar, I'm gonna close out. So I moved my stop here to capture some of those profits. And I got lucky here that the market did continue lower, because in reality, this is a really strong signal for the market to keep going down. But that was a really good lesson for me to learn. And I hope you take this away too, is when you get up a certain amount, I like to use 3 times my profit. I go with a really tighter trailing stop. And so to close this trade out, I just saw that it was starting to go higher and I got out, and that is totally okay. Sometimes you just got to get out and pull the plug when you don't feel like you're seeing the market properly. Just to illustrate what I'm talking about, here is another example where the market puked lower in my favor. Now, generally these type of moves only happen to the downside. That's just because how the market moves. But just like the last trade, you know, my stop was up here. It started to move in my favor, moved to break even. And then I actually moved it down with this swing with the price action as it started to break lower here. But as it started to really break lower here and I hit 3 times my risk, which is about $800, $700, I just ratchet my stop up to the previous candle's high. And so all that is the high of the last candle. And so this is the most recent candle forming right here. And then as soon as that finishes, I just move the stop down with it. And so that's all I do when in a spot like this, because you can see how rapidly this is making me up money. And when it breaks that, I don't want it to do like what we saw in the last trade of just ripping back and taking those profits back. When you're up so much money, you just have to get out. You will not get 100% of the move most of the time. And that's just how the market works. But you do not need the whole move to be consistently profitable trading. So if you want to learn more about this strategy I use, check out this video right here. And if you want to just learn everything I know about trading, I have a course that I linked in the description below.